สวัสดีค่ะได้เวลาการนำเสนอข้อมูลของบริษัท PSL Shipping นะคะโดยคุณคาริดฮาชิมกรรมการผู้จัดการบริษัทและคุณกุชูวาเดียกรรมการทางด้านการเงินและช่วงสุดท้ายในเรื่องของคำถามคำตอบก็ยินดีรับทั้งภาษาไทยและภาษาอังกฤษนะคะค่ะเชิญคุณคาริดค่ะ
Good morning, everybody. As usual, we will have this presentation in two halves. In the first half, we will talk about the industry structure. And in the second half, we will be much more specific about the company itself. So if you look at the overall picture of shipping, you can see that pressure shipping is in the dry cargo sector. And we also have a few specialized cement ships. And in the dry cargo sector, we are in the handy-size sector and in the Supermax and Ultramax sector. This is a slide that shows you how the BDI has been faring over a long period of time, beginning in 1985, taking you through the first really great recession that we had, that was in the middle of 1986, taking you through the bull run that was there thanks to China joining the WTO, starting in 2003 and ending at 2009, 2008, post Lehman Brothers, and continuing all the way to the present. If you were to look at the same slide, but look at it in the form of average BDIs for the years, then you can see some sort of a pattern emerging, and you can see clearly that we had a good run in 2004, followed by a slight dip in 5 and 6, and then a really good 7 and 8 before the market started to level off. And you can see that the low point of the cycle was reached in 2016. It was even lower than the last low point in history, which was in 1986. This is the expanded chart starting in January 2016 and taking you all the way to the current position. So if you look at this chart, it sort of showed you a sustainable pattern, except that we've now had lows being established in the early part of 2019, which sort of makes you wonder whether we're going to go and explore the lows that we had in 2016, or are we going to bounce back from here? So that's the question on everybody's mind. If you were to look at the relationship between scrapping and the BDI, you can see it's an inverse relationship. For example, in Q1 2016, when the market was really, really low, 360 points, on an average, about 55% below the last all-time low on an annual average basis, we scrapped 14.2 million tons of ships. If you look at the year 2016 as a whole, you can see that we scrapped almost 30 million tons of ships, whilst the average of the BDI for that year was a low 673 points. Now, when you come to 2017, the BDI average for the year was 1145. It sort of doubled. And at that doubling point, you saw that scrapping came down to half, to 15 million tons. And if you look at what's happened in 2018, sentiment had increased. People were more confident. And as a result, even though the BDI did not go up very significantly on an average basis, it still made scrapping fall down to an almost all-time low of only 5.25 million tons of ships. So starting in 2019, you can see that the average of the BDI up to the 5th of February was 1,012 points, and scrapping was less than a million tons. So this is not good news in terms of the scrapping side, but the weakening of the BDI, which it has significantly done so during the months of January and February, might encourage people to look at the scrapping option a little more closely. So the question is China really, is their growth sustainable? So if you look at these bullet points that I put up for you, one is that China is switching over to producing good quality steel and no longer producing just normal steel. To do that, you need very good quality iron ore, very good quality coking coal, mainly from imports. Since North Korea has been deemed as a pariah state. Since that time, China has stopped importing coal from them, and they used to do 23 million tons per year, mainly over the land border, and if it was by sea, it was a very short ton-mile distance. So all that has moved out into the international markets. China is very keen on reducing pollution, and one method of reducing pollution is to burn better quality coal, better quality iron ore that reduces the amount of pollutants reaching the air. China is also trying to shut down many of their inefficient and illegal and very small coal mines for two reasons. One is that they produce very poor quality coal, which when burnt releases a lot of pollution. Two, they create a lot of unnecessary deaths in the mines, and as a result of that, there's a lot of protests by the people who survive and their families. So the government is keen on closing it down. They've almost achieved their target of 800 million tons of closures a year in advance. I think by the end of this year, they will have reached that target. Besides that, they're also trying to cut down the unorganized sector of iron ore mining, and they have withdrawn lots of licenses in that sector. They've also put in place from 15th November to 15th of March a cap on production of steel, cement and aluminium in 14 provinces, especially in the winter months, the idea being that to reduce the level of pollution. And if you look at the latest data points which are there on China, you can see iron ore imports for 2018 were down by 1.1%. If you look at coal imports, they were up by 3.2%, but that does not tell you the whole story. Up to the 10th month, it was around 14%. And then it just dropped off a cliff in November and December and January also, because the government imposed restrictions on import of coal in China. The reason for the government to do that was that their coal mining sector, which is responsible for about 3.5 billion tons per annum of production, was in a mess. Pricing was just too low because the imported coal was coming in at a very low price. And to save that part of the industry and the employment that it generates, the government decided to control the amount of imports coming in. As a result, prices of coal in China have gone up significantly in November, December, January, and even in February. As a result, coal mines are very profitable, but I guess in a very short while, the consumers of coal will start to scream, saying that they are losing money, and then the government will again remove the controls on the imports. And this happens quite regularly in China over the last few years. It's been happening very regularly. You look at steel production, it is a gigantic 8.8% up. 82.4 million extra million tons of steel were produced in China. That is equal to the number 3 country's production ability. That's America. America produces about 80 million tons of coal. Number 2 country in the world, Japan, produces about 95 million tons of coal, of steel. And against that, China's increase in the steel production for 2018 was equal and better and stronger than America's entire production facility. If you look at steel inventories, they're marginally up at 0.2 million metric tons. If you look at steel exports, they're down by 6 million metric tons. So if you do the math, you would see that China has consumed something like 11.3% more steel last year than they did the year before. And mainly it's going into the One Belt, One Road, or the Belt and Road initiative. So this gives you in graphical form iron ore imports and coal imports. So you could see that how coal imports on the right-hand side slide, if you look at the last 2 months, you can see how it's fallen off a cliff. And that is what has hurt the market during the last 2 months of the year, and into January and Feb. Similarly, for soybean imports, it's down by 7.8%, mainly on account of the trade war. There was not enough soybeans available in the rest of the world, and therefore they had to curb their appetite. Plus, they had an attack of swine flu, so a lot of animals were culled in China, and therefore the need for feed was not as strong. But again, you can see that China is a world beater in terms of bulk imports. If you look at steel production, which is the top part of the slide, look at inventories, which is the left-hand side, and look at the exports, which is the right-hand side, you can see that China has slowed down exports significantly, has increased production dramatically, and inventories are more or less in line with last year. So again, it shows you the consumption story in China is pretty strong. These are the numbers of China, and you can see clearly that the GDP growth rate, which is the first row, bears no relationship to the amounts of iron ore imported, coal imported, or steel produced or steel exported by China. So these are, so if you just go by the headline number of China's economy slowing down, you might misread the dry bulk market, because in the dry bulk market, what is more important is the volume of cargoes going in and out of the country. Coming to the supply side. If you look at the supply side, as I said, last year only 5.25 million tons of ships were scrapped. And as you can see in the lower portion of the slide on the extreme right-hand column, we had a growth of 22.93 million deadweight tons of ships, equal to 2.82% of the existing fleet. So we had a large rise, net growth in the supply of ships. Despite that, remember, 2018 turned out to be a very profitable year for most ship owners. This is the forward order book. This gives you the total supply of ships that are on order today as compared to, sorry, this is basis the 5th of Feb, not from the start of the year. It's from the 5th of Feb, the latest data that we have. And it shows you what is there to come up to the end of 2022. So you can see in that the total until 2022 is 89.08 million tons, deadweight tons of ships, or 10.62%. Now, if you look at that and the breakup, it shows you that 80% of the new ships which are coming are in the larger size, in the sector that we are not involved in. And if you look at the sector that we are involved in, it's only a total of 13.23%. So it's very low compared to the 80+% which is there for the gearless ships. This is a slide which shows you the contracting of ships in any single year, which is the green line, versus the Baltic Dry Index. And it is just to show you how crazy ship owners can get. That when the market starts to go up, for example, in 2006, 7, and 8, look at the volume of ordering that has taken place. If you were to look at it in percentage terms, in those 3 years, more or less, they doubled the existing fleet. So it's just crazy amount of ordering, and that is why we've had a long 10-year recession almost. But if you look at the last few years, starting in 2015, or rather 15, 16, 17, 18, and even nothing much from the data on 19, but these 4 years, if you look at, you can see that the majority of ships being ordered are only the larger gearless ships, not the smaller size ships where we are involved in. Now, if you were to compare 2017 and 18, you could see that the volume of ships delivered from the yards, new ships, was down by 26%, or 10 million deadweight tons compared to the year before. But if you look at scrapping, it's just the opposite. We've gone from 15.16 million tons of scrapping to 5.25 million tons of scrapping. Therefore, we have an additional 9.91 million tons of ships being retained in the fleet, or roughly the scrapping has dropped by 65%. So this is not good news, but this is an inverse relationship to the market. It means the market was strong in 2018. If we were to look at the numbers starting at the turn of the century, you would see the following. You'd see that the bulk fleet started out in 2001 at 286 million deadweight tons, and at the end of 2018 had reached 836 million tons, so almost a 3.5 time increase. And you can see that the compounded annual growth rates we've given you for 2 separate 8-year periods has been 6% per annum and 7.5% per annum. So it's been crazy. And all these ships have come in and kept the market fairly depressed. If you look at 2019 and 20, the growth rate is at the lower end of the scale. And again, in that growth rate, if you see, the gearless ships take up the majority of the ships that are going to come. So supply side going forward on the smaller sectors or the geared sector, that's where we are involved, should be less intrusive, less oppressive to the ship owners. Coming to the demand side, we analyzed data from the IMF on world GDP growth rates, and we did time series starting in 2000, ending in 2018, and we compared that with the ton-mile growth rates as given by Clarksons. Now, unfortunately, Clarksons doesn't have a time series running prior to 2000. They only have data from 2000 onwards. So when we looked at that data and analyzed these two sets of numbers and did a regression analysis, what we found is that the growth in ton mile is 98% correlated to world GDP growth rates, which means we are a derived demand from world GDP. So if world GDP is strong, we will do well. If world GDP is negative or poor, we will do poorly. Now, we also wanted to see if we could find out some sort of heuristic or a rule of thumb out of this data. And what we found is that if you take the 18-year or 19-year data that is there, you will find a good fit at the 115 basis points, which means that more or less every year, if you add 115 basis points to world GDP growth rates, you will arrive at ton-mile growth rate. It's not to say that it will be absolutely accurate, but you'll be more or less right every year. Some years you'll be slightly erring on the softer side, sometimes on the harder side. So it just depends, but it's a good fit. Statistically speaking, it's a good fit. Now, just to put the forward order book into some sort of context, if you look at the entire dry bulk fleet, it is at 836.46 million deadweight tons. This is as of the end of the year. And at the end of the year, if you look at the extreme right-hand bar, it's not very visible, but let me give you the numbers. The ships that are 20 years or older, which is the red line, is at 7.06%. If you look at the bar itself, it's at 10.5%. And if you look at the triangle that I've given you on top in red, it's at 11.8%. That is the amount of ships that would reach their 20th birthday or older by the end of 2022, which is what the order book is. The order book is all the way up to 2022. So if you compare like for like, you can see that you have more than 11.8% of ships which are older than 20 years of age, and you have an order book of 10.5% against that. If you were to look at the same thing on the handy size and the Supra and Ultra Max space, this is what you would see. You'd see that the forward order book is at 6.9% at the end of the year. The 20-year-old existing fleet is at 13.2%, and at the end of 2022, the 20-year-old fleet would be at 18.1%. If you look at the Ultramax space, you can see that the blue bar, which is the forward order book, is at the 7% level. The existing 20-year-old fleet is at the 8.4% level, and the existing the 20-year-old fleet going all the way to 2022 would be 13.6%. So again, the new ships on order are much less than the older existing ships in the fleet. So therefore, going forward, we should not have too much of a strong net growth in tonnage. Coming to trade wars and tariffs, basically trade sanctions just move cargoes around. What China was buying in terms of soybeans from America, they started purchasing from Brazil. But last year, because Argentina had a drought, they couldn't sell as much soybeans as they would normally have done. But what they did, because of the trade war, was they imported a lot of soybeans from America, used that for their domestic production, and sold some of their drought-affected crops to China. So China was short by about 7.8%, if you remember, on the earlier slide, in comparison to 2017. So that was because they didn't buy American soybeans and there was not enough soybeans available, and plus of course they were affected by swine flu on their crop. So trade sanctions basically move cargoes around, they don't necessarily stop cargoes. Coming to regulatory changes and what's there in the future, there's a lot of regulation which is coming in against shipping. Now, I'm not going to go into detail. If you would like, please study it on your own. And if you have any questions, you can always approach us and we'll explain them to you. But the two real regulatory pressures in terms of cost, which are immediate, which are coming up in front of the owners, are ballast water management and the IMO 2020 of burning low sulfur fuel oil. Now, I've just shown you a picture from our ship on the left-hand side, which shows you how large a ballast water management treatment system is like. And if you imagine, if you have an older ship, your engine room will not have so much space. So you'll never be able to put this type of a system on board. You'll have to maybe keep it on the main deck, which means you'll require more heavier duty pumps. So the older the ship, the more difficult for it to retrofit something like this. Similarly, on the right-hand side is not from our ships, but from some other installation on some other ship, a scrubber unit. So you could burn low sulfur fuel oil from 1st January 2020, which is the easiest and best solution, or you could go with a scrubber plant. So what does a scrubber plant do? Essentially, it washes the exhaust gas and you can continue to burn very high sulfur fuel oil or dirty oil, clean the gas as it's leaving, and it appears, at least on the gas front, as if you were burning clean oil. So that's what some people have decided to do. It's an expensive exercise, costs $3 to $6 million per piece. But more than that, it also creates a dirty slurry of water, which is generally speaking on an open loop scrubber pumped back into the oceans. Now, many countries have already come out banning open loop scrubber operation within their territorial waters. So it's something like, if you remember in the olden days when you traveled on an aircraft, maybe 20% of the aircraft was reserved for smokers. And the balance 80% had to suffer the consequences of those 20% smoking. And after some time, they realized this is stupid. You prevent or you allow some people to smoke, and then you say the rest of the others are non-smokers, so they're not getting the smoke, but it does eventually reach you, and therefore they banned it completely. So I suspect that in 2-3 years' time, open loop scrubbers will be banned everywhere because they do add pollution to the oceans. And ports have already said you cannot come into my waters and use that, but they could be using it almost up to the edge of the port, which means the water there will be polluted and of course will flow into the port, and sometime later the ports will say we'll expand this limit to 12 miles and then to 240 miles and then eventually say ban them. And that's what I suspect will happen for the scrubbers. So as far as we are concerned, we have not used this. We're just going for burning clean oil. Now this shows you how this thing has been changing over a period of time. So for example, if you go back in time to the turn of the century, we were burning 4.5% sulfur fuel oil. Then this changed in 2012. In 2012, it came down to 3.5%. And now in 2020, it's going to come down to 0.5%. Now, whilst this was going on, there were special emission control areas or areas where they were ecologically very fragile. So many governments put in bans there saying that, yes, you can burn 4.5% sulfur somewhere outside, but when you come here, you have to burn 1.5% sulfur. This was there from 2010, but then they dropped it to 1% in 2010. And then in 2015, this has been dropped to 0.1%. And I suspect if you look at these two lines, they will merge going forward in the future, and you will come down to 0% sulfur. So this is something which is going to happen in the future. So it's best to burn low sulfur fuel oil, and when they come down to 0% sulfur, then we just buy 0% sulfur and burn it. So what does IMO 2020 mean in reality for ship owners? So basically, should you buy scrubbers or not? I've explained we would not go for scrubbers. Switch to low sulfur fuel oil options, including distillates. or switch to LNG fuel. That's another option. That doesn't have any sulfur at all. So the question is which fuel to use if you're using low sulfur fuel oil. Are compliant fuels available everywhere? And what will be the cost? So those are the three questions that will face ship owners there. Question for the customers. Freight rates will increase because if you buy a better product, we are confident it will cost slightly more than the older, dirtier product. So you'll have to pay some more. Bunker costs, which are roughly about, people have been scaremongering saying that this gap between high sulfur fuel oil and low sulfur fuel oil will be as high as $400 per ton. We think it'll be closer to between $40 and $100 per ton, not as high as 400 as what people are scaremongering. But if it was, then it will become 80% of your voyage cost, the bunkers, which means that you will try to slow down your ship as much as you can to reduce that cost. And the question then finally is, can you pass on these costs to the clients? In the model that we employ, it's like Hertz Rent-A-Car. When you go to Hertz Rent-A-Car, if you take the car and if tomorrow, say, the government decides to raise petrol prices, you would be responsible for that cost, not us. So that's how it happens with us. So our customers would bear the cost of this oil. Now, this shows you how many ships have actually, and this is the data as of the end of the year. So as of end of 2018, 471 dry bulk ships had retrofitted scrubbers. And amongst the brand new ships which are still to come, 106 dry bulk ships have ordered them with scrubbers. So if you look at it in terms of percentages, we have 4.1 to 4.7% of ships in the dry bulk space which will have fitted scrubbers. If you look at LNG, there is just 6 ships which have retrofitted, changed the engine, removed the old engine, put in a new LNG engine. And 5 more in the new ships which are coming with LNG fuel. So really LNG fuel is not an acceptable option for ship owners because it's just too expensive. So really speaking, in terms of percentages, you can hardly read that. 0.05 of existing, and if you take the new ones into account, 0.09. So it's nothing. But if you look at what's happening in terms of the age profile of ships and what they would face in the next 8 quarters starting in Q1 this year, you would see that almost 40 million tons of ships will come up with a milestone birthday. What is a milestone birthday? Every 5 years in shipping, you have a milestone birthday. And on that milestone birthday, you have to spend a lot of money to do your special surveys and dry docks. So here you've got 38.5 million deadweight tons of ships, which in the next 8 quarters will either have their 20th birthday, 25th birthday, or their 30th birthday. And at that birthday, they'll have to spend between $1 million to $3 million to do the special survey, spend another $500,000 for the ballast water management system. And if it's an older ship, they can't burn low sulfur fuel oil, then they have to put a scrubber on board, which will cost them $3 to $4 million. So really speaking, it's nonsensical economically for any owner to keep these ships alive post 1st January 2020. If you were to then analyze, dig down deeper and look at it just for our sector, it's about 14.5 million deadweight tons of ships out of the 38.5, which is coming up for their special surveys of their 20th, 25th and 30th birthday. If by some magic none of the ships are scrapped and they all survive, then on the 1st of January 2020, you would have 68 million tons of ships, which would be greater than 20 years of age. And by the end of the year, that would have expanded by another 10 million tons of ships. So really speaking, we have a very large old age population within the existing fleet. So what are the oil majors saying in terms of low sulfur fuel oil availability? Because this is the biggest challenge that the scaremongers or the scrubber pushers were trying to portray. And if you look at this, you can see more or less every major oil company and every national oil company has come out to confirm and say, we will supply you with as much low sulfur fuel oil as you need. So availability is no longer an issue. Only question is of price. So in terms of price, let me just give you one example of what we have just discovered. We had a ship of ours in Argentina on time charter to another company, and they ordered the bunkers on the ship. Obviously, at this time, you would be buying only high sulfur fuel oil. And when we sent that sample of that oil for analysis, we were pleasantly surprised to find that the sulfur content of the so-called high sulfur fuel oil in Argentina was 0.2%, much below the limit of 0.5% which you have to burn. And what was the price differential between the Argentinian oil that was supplied to our ship and Singapore on the same date was less than $45 per ton. So we think that that should be about the differential to be paid for low sulfur fuel oil compared to high sulfur fuel oil. Now, of course, what steps can owners take post January 2020, 1st January 2020? Slow down your ships. This is the easiest. You want to reduce the cost, slow down your ship. If you slow down the ship, the consumption will drop. If you drop the consumption and you reduce the speed by 2 knots, you are effectively removing almost 17%, 16.7% of the world fleet at the stroke of midnight on 31st December 2019. So on 1st January 2020, you would be reducing the fleet almost by that if the world fleet in dry bulk were to reduce speed by 2 knots to save on cost of low sulfur fuel oil. Now that is provided the cost differential is really, really high. That's what the scaremongers and the scrubber pushers have said. If it is $400, yes, that's what would happen. But if the differential is this $40, $50, $100, then it'll be much milder than this. But yes, there will still be some loss of tonnage due to slow steaming. So that will increase. So what is our strategy? Our strategy is to wait for the markets to improve. It had done very well in 2018. However, in 2019, starting with the trade war, creating uncertainty, the global economy slowing down, Brexit, European Union issues on budgetary items, the December slowdown in the developed world, the end January, early February slowdown in China, bad weather in Brazil and Australia affecting shipments, and then the big mine collapse in Brazil. All these factors have come together and created the perfect storm, and you have seen, and especially with the government of China putting a restriction on imported coal into China, has really collapsed demand in a sharper way than anybody had expected, and the markets have come down sharply. All of us had thought at the start of 2018 that 2018 would be a reasonable year, 2019 would be even better, and 2020 would be the best year. But as they say, man proposes, God disposes, and we have seen now that with these various incidents that have taken place, the market has come off quite sharply. So we've got to wait to implement this strategy of ours. This is the existing fleet of the ship. It's still 36 ships. Obviously, the ships have aged by 1 year. It's 1 year older, so it's 7.25. Other than that, more or less, everything else has remained the same. This is the forward order book, the forward fixed contracts that we have. And you can see clearly that the fixed contract price is strong, at ending at 14,550 in year of 2023. And in terms of percentage of the fleet, it starts at 18%, comes down to 14%. So these are all fixed long-term contracts. Market segmentation, if you look at Q4 results, we outperformed the market on the Handysize by 12.42% in that quarter. On the Supramax, we were below the index by 2.91%. Remember, our ships are not index ships. If we compare them with index ships, they are at 85% of the index ships. So effectively, 3% lower than index is actually a 12% outperformance for our ships. And then the Ultramax outperforming the index by 14%. Remember, Ultramaxes are about 5 to 7% above the index. They're better ships than the index ships. So yes, our outperformance is by about 7-8%. If you look at the whole year, it's 19%, minus 1.43%, and 14%. So we've done pretty well last year compared to the market. So to summarize quickly, 17 and 18 taught us that demand-supply balance is really close by, leading to almost profitable years in 17 and a profitable year in 18. 19 and 20, demand growth should be about 1 to 2% higher than supply growth, because if you remember, supply growth is growing at about 3%, world GDP growth rates are going to grow by about 3.5%, and the heuristic says that you have to add another 100 basis points to that. Order book to existing fleet ratio is pretty benign, so we don't expect too much of increases. And if there is a supply side dividend thanks to 2020, either through slow steaming or through scrapping of ships, we could have a reasonably strong market coming into 2020. Of course, future environmental rules are getting more and more difficult, as I've said, and therefore prudent ship owners will not be ordering too many new ships. So from that point of view, and also the fact that this market has started to weaken at the start of this year, it will prevent a deluge of ships being ordered, which is what ship owners are very capable of doing. The only two downside risks you have is geopolitical, where, with Trump there, you never know what can happen tomorrow. And therefore, again, this tariffs, which has already acted badly for the world economic growth, has created issues. So coming to the financials, Kushu will take over and walk you through the company's financials.
So here we have the financial highlights on the income side, on the income and expense side. So as we said, 2018 has been a good year. It's been a profitable year for the first time in 5 years. And this is the fourth quarter of 2018 was the fifth quarter of sustained profitability. So we ended the year with about $14 million of profit. That essentially came from the higher rate or the higher freight rate or the higher TC rate, the time charter equivalent rate, which we earned as against $9,500 per day per ship in 2017. We earned about $11,000. So this is the key reason where a $1,500 difference or an increase has led to a profit increase of approximately $18 or $19 million. So this really tells you the sensitivity or the operating leverage which works over here. That just $1,000 increase can actually increase the profit by $10 million. $1,000 per day per ship leads to an increase in profit of $10 million. In percentage terms, again, it can be very, very big. And that is essentially the nature of operating leverage, which works in shipping, especially in our particular model. On the cost side, operating expenses are near about what we were in 17, barring marginal increases on 2-3 items, mainly on the dry docking and the stores and spares side of our ships, where our ships obviously have now become 1 year older, and apart from being 1 year older, they are entering their first dry docking cycle. That is, the new ships which were delivered in the previous 3-4 years are now entering their first dry docking cycle. And that entails little bit of cost, and which is what is reflected here in the marginal increase in operating expenses on an average daily basis. Other than that, of course, you can see by and large all ratios, etc., have improved. This one tells you what is our financial position like. So our financial position definitely has improved from the position of what it was in 17. Mainly, once again, on account of the fact that we made that $14 million profit. So that $14 million of profit has led to an increase in shareholders' equity by $14 million. This is exactly what it was. Other than that, the big change in this particular year is our long-term loans also reducing substantially. So which indicates that whatever extra cash flows were generated, we use those cash flows to bring down leverage or to reduce our long-term loans by way of repayment whenever they had to be repayment, and sometimes by way of prepayment, that is voluntarily prepaying in advance to bring down this particular number. So that is what is our intention, that is what is our strategy going forward in the very immediate future, is to use whatever cash flows are generated to bring down leverage and bring down let's say, for example, if you look at the debt equity ratio, to bring it down to somewhere in the region of 0.7 or 0.8 from about 1.1, which it is right now. Other than that, as you will see, we have these 9 hulls arbitrations ongoing in London. These remain pending. The number here, $64 million as advances to Senti, remains as it was in the last 3-4 years. This is the amount which is under arbitration, so as to say. And we expect that the arbitration awards should come within next year. Middle of next year, perhaps, is the last award. Bear in mind that there are 9 arbitrations ongoing, out of which these have been categorized in 4 categories. The 11 arbitrations we have is categorized in 4 categories, 9 being categorized in 3 categories. So we may have 3 awards for each of these 3 categories. But that's something which we have to wait for. We have to fight out these arbitrations, and then we will have the final result. Other than that, as you can see, total liabilities have reduced. Assets have reduced marginally. That is purely on account of the depreciation on our total assets or on our fixed assets. That is the ships which we have. Other than that, we continue to have 36 ships. We had 36 ships at the end of 2017. We still continue to have 36 ships. There's nothing which has been added, and there is nothing which has been deleted. Next is operating expenses. If one looks at it in sort of greater detail, as I said, if you compare the operating expenses numbers with the previous year, the major changes you will find, or the increase you will find, is on account of dry docking special survey expenses for the reasons I explained earlier, and stores and spares, once again, and then marginal increase in management expenses. So that's where we are. We are at $4,621 is what we spent per day, per ship in 2018 towards operating expenses. And our target for 2019 is going to be $4,750. Now, if we look at that $4,750, and if we look at what the industry has been doing, as you can see consistently, year by year, our operating expenses are in the region of $900 to $1,400 less than the industry. So this is something which is an advantage, a strategic advantage which we have, and we hope to continue with this kind of advantage over our peers in the industry. And bear in mind that when we say that our operating expenses is $1,000 less than the industry, which means what we are saying is, as I said earlier, that $1,000 translates to approximately $10 million of profit. So by reducing or keeping the operating expenses at a lower than industry level, we are anyway starting with a $10 million advantage or a $10 million positive as compared to our peers in the industry. The next slide is a similar graph, but in a different pictorial manner. And this essentially brings out and shows the gap between our operating expenses, the positive gap between our operating expenses and that of the industry. This is something which gives you the history, and history right from 1995. So it encapsulates some of the cycles which we have seen in the industry, and this particular slide actually encapsulates how we have gone through the cycles in terms of our age of our fleet. That is the first sort of bar or boxes which you see. Then how we have gone through these 23 years in terms of the average size of our fleet, in the sense, what would be the average size of our one ship in our fleet. Then, of course, we have the next line showing you what was the freight rate or the TC rate which we earned on our ships. And then the next line, the last line, giving you the operating expenses per day per ship. So these are the key sort of numbers which have driven the company and the company's financials. So if you look at the age, the conclusion is that right until 5 years back, we have been around the 15 years. Our fleet has been around 15 years of age. We reached a peak in sometime in 2008, where we had a fleet with an average age of 21 years. Otherwise, by and large, the average has been 15. And thereafter, if you look at from 2014, this average age has been coming down, and it came down to a low point of about 6 years in the previous year, in 2018, and right now, the age of our fleet is 7 years. So this is on account of the fact that during these years, during these past 5, 6, 7 years, we have recycled or sold our older ships, thereby bringing the average down. And we have added newer ships which we have ordered. So we had ordered ships from 3 shipyards. All the ships which we ordered, of course, did not come to us. They were not delivered. As you know, we have had arbitrations with another shipyard also. But whatever ships were delivered to us, that has led to an increase of the size of our ships, because we ordered, barring 2, we ordered only Ultramaxes, which are the bigger ships. Other than that, we ordered 2 large handy sizes of 39,000 tons. And therefore, the next line which you can see, our average size per ship of our fleet has jumped up from about 25,000 deadweight tons about 8-9 years back to 44,000 deadweight tons. So which now tells you that we are more of the Supra or Handymax or Ultramax operators rather than the exclusive handy size operators which we were in the first 10 years after 1995, or even first 15 years after 1995. So in that sense, the profile of our fleet has changed, the size has gone up, and the age has come down. For the first time in our histories, in the last 3 years back, we came down to a single-digit level as far as our age is concerned. So we reached the low point of 6 years, which was a very, very young fleet which we have been operating. Apart from being young, of course, our newer ships are very modern, technologically sound, and eco-friendly in terms of its oil consumption. So that is on the size and the age side. In terms of the earnings, if you see 1995 was a peak year in that particular cycle. So that shows that peak year rate was about $7,000. And then, of course, came the Asian financial crisis, the Tom Yum crisis, as we all call it, where our earnings or freight rates came down to sub $5,000 levels for about 2 or 3 years. Thereafter, from 2003, as we said, with the advent of China coming in a big way in the commodities market to satiate its large hunger or appetite for the commodities in terms of iron ore, coal, the shipping markets, of course, went up. And we reached a peak, as far as we are concerned, we reached a peak in 2008 in terms of earnings of $16,500 per day per ship. So this is a historical peak on an average basis for our fleet, which we have reached. Thereafter, it has been a sort of a downhill scenario until 2015 and 16, where we came down to around the $6,000 odd levels. This, as you know, coincides with the BDI coming to its all-time historical low point in the first quarter of 2016. So this is how it is reflected in terms of our earnings. And thereafter, we have seen the recovery in 17 and in 18. So therefore, we had a reasonably good year in 17, where we almost broke even with a TC rate or an earnings rate of $9,500 per day per ship. That, roughly speaking, gives you an idea of our break-even rate, that around the $9,500 per day per ship, all other things remaining same in terms of our operating expenses, in terms of our finance costs, we would break even at around the $9,500 level. Since we had $11,000 earnings in the last year, as you can see, we had a profit of around $15 million. So that's how it has gone. In terms of operating expenses, we used to be around the $3,000 levels, but as things changed, as the industry changed, and importantly for us, as our fleet grew older and older, and we kept on managing or operating these ships, our operating expenses came up to as high as around higher than $5,000 per day per ship. Thereafter, as you see the age coming down of the ships, that is the older ships going out of the fleet, the younger ships coming in, has a direct effect on the operating expenses. Operating expenses then came down to a low point of about $4,300 in 2017, which coincides exactly with the age being the youngest age of the fleet. And thereafter, as we are now getting older, there is marginal increases, but we expect that we should remain at the sub $5,000 levels. And in any case, we hope to, and we always target to maintain the positive gap which we have between our operating expenses and that of the industry. So these are the real big pictures. These are the real key takeaways of the financials. Other than that, I'll run through some of the other numbers. So continuing the story, this is exactly the same story which is reflected here in terms of the debt or the debt to equity ratio. When we have had poor years or when we are near the bottom of the cycle, we have had high debt. We had high debt, the peak debt of almost 4 times in terms of if one compared it with the equity at the peak of the Asian financial crisis. Since then, we came down for a couple of years, right down to 0 levels. Once again, coinciding with the boom years between 2003 and 2008. And thereafter, creeping up again because of the fact that we had to add ships, and most of our ships or almost all our fixed assets are generally funded through a major portion of debt only. So that debt levels came up to a high point of around 1.3 times. And then since the last 2 years, as we have been bringing down the debt through repayments or prepayments, that has now come down to 1.1 levels. And as I said, in the immediate future, the target would be to bring down this debt to equity to almost 0.7 or even to 0.5 levels. I've been told we are short of time, so I run through faster. Debt to EBITDA, same story, same trend. Peak in 2016, reflecting the gloom and doom in the markets, in the industry, lower values, not debt, no cash being available, etc. And now come down to around the 6 levels. Very soon we'll be sub 5. Next one, cash operating profit to operating profit. As you can see here, we have had 4 years where we sort of lost cash on an operating levels. These 4 years are those 4 years, 2 years in 98, 99, and 2 years in 15, 16, which were the worst years, especially the year 16, which was the all-time low points reached in the shipping industry. Net profit, cash profit, again, similar numbers or similar takeaways, similar conclusions you can take. During those 2-4 years, we have lost cash. Other than that, we have not really lost cash in spite of our profitability or the accounting profitability after depreciation being low or even at zero levels. We have not lost cash as such at all. So in a sense, we have therefore been reasonably healthy. Dividend policy, we have had this dividend policy where we were consistently paying out dividends on a quarterly basis. We stopped that. We stopped paying that in 2014 for obvious reasons. As we bring down debt and bring down leverage in the balance sheet, we hope to recommence the dividend payments. Financial profile, as you can see, improvement all around. If you compare what we were in 2013 to what we are now at 2018, we have 36 ships, but the total deadweight tonnage of these 36 ships is more than what it was in 2013, although 2013 we had 40 ships. But because our average size has gone up, because of the larger ships which were delivered to us, our total deadweight tonnage is actually at a higher level than what it has been. We continue to be nominated for various awards, whether it is in terms of corporate governance, whether it is in terms of ship operations, industry, etc. So therefore, this is a list of what recent nominations or awards which we have got. This is a pictorial representation of those awards. This is another pictorial representation of those awards. We have, as I said, in terms of corporate governance, we continue to give corporate governance a lot of importance, and that is reflected by the ratings which we get on corporate governance. We are rated consistently as a company with 5-star given by the IOD in association with the SET. So we have been rated for 6 years in a row under our category. 9 years in a row under our category with a 5-star rating and a top quartile position within our category. Marine Money New York comes out with a ranking based on the financials, the published financials of all shipping public companies in the world. So they have sometimes a population size of as high as 140 companies, sometimes 120, depending on how many the public companies are left. Sometimes there are more, sometimes there are less. So we have been ranked pretty high, barring the last 2, 3, 4 years where we have seen the dry bulk bust, as I would like to call it. Other than that, but even within those periods, if one were to rank ourselves with our peers, we have been ranked pretty high. So we have come out, we have a ranking of 32 based on 2017 financials. As you know, 2017 financials were not as good as 18. We in fact had a loss, but in spite of that, we were ranked 32, so which actually shows that we have performed or we are ranked pretty highly. If we were to strip out the dry bulk sector or the dry bulk shipping companies from this particular ranking table, we are ranked in 2017 number 3 among the dry bulk companies. So which once again tells you that we continue to be ranked highly, even if one were to do a quantitative analysis, which is what is done by Marine Money on the rankings. We are spoken very highly of, so this is some of the extracts of how Marine Money has spoken about us. We have been called the champagne toast in some years where we weren't tracking that high, but words of appreciation were granted to us. Total returns to shareholders, notwithstanding the current share price, if one were a long-term shareholder or a long-term investor, here we show that if you had invested in 1993 in the IPO of the company, you would still be 11.2 times ahead, in the sense that you would have recovered 11.2 times the cost of your investment. This is another way of looking at another way of looking at this is that if you had not invested just in 1993, but if you had invested at various points in a 5-year interval or at 5-year gaps, you would still be ahead, barring a 5-year gap, where obviously because of the total downturn in the last 2-3 years, which we have seen, is that the share price has come down. But as we said, in the long term, given our fundamentals being very, very strong, this can change very, very quickly, given the volatility which you see in shipping. So that is what we have. I apologize for having overshot my time. I don't know whether we have time for questions.
Whilst we are waiting for questions from the floor, we have quite a few from the net. So I'll just quickly run through those questions. In management's view, how will the IMO 2020 affect the supply side? Will it change or decrease, and in what percentage? So in percentage terms, we are not sure, but we are sure that it will help to decrease the world fleet. So if you look at question number 2, they want us to summarize the arbitration disputes. So here there are totally 11 arbitrations on. 2 have been fully argued out in front of the tribunal. We're waiting for that award. But these are warranty claims. These are claims on the 2 ships that we took delivery of and where there's a warranty claim. Other than that, there are 9 arbitrations that are still ongoing where there is no final result as yet. So we just have to wait, and as Khushu has said, likely results will start coming in sometime in the middle or the second half of next year, not before that. Coming to the third question, outlook for the BDI for this year, and what things should we focus on to get ahead of the curve. So I think the outlook for the BDI depends a lot on what happens in terms of the supply side, because so far till today, for the last 3 or 4 years, supply has been growing, but demand has been holding up the balance. Right now, for the first time, demand has started to slow down. So to predict what the BDI will be this year is difficult. But let me put it this way, that if the trade tariff resolution between China and America is resolved, then we could have a very good year. Can't give you in percentage terms or what the BDI would be at the end of the year. The next question is, what is the time charter budget for this year? We don't have any budgets. We have a target to beat the index ship. So that will still be maintained. So whatever the index ship is, we'll try to beat that. And what is the outlook for the shipping market this year and the trend? We think that this year, if things are resolved internationally, then it'll be a good year, and the trend should be still upwards. And the final question is, what is the number of existing ships? It's 36. Are there any capital expansion plans? None. Do we have any plans to sell our ships? At the moment, none. So that's the answers to all the questions from the net. And we have been signaled that time is over. So if you have any questions, we'd be happy to meet you outside and answer them. Thank you.